Hello, this is Kirill from forexboat.com and welcome back to the course on money management. Today's going to be a really exciting tutorial. We're going to talk about the Kelly chart and we will analyze different types of risk exposures that you might want to undertake in your trading. So to start off with, this is our Kelly chart that we already have seen and we're familiar with. The green line is the line that describes the profile of your returns depending on your risk exposure in practically any trading strategy out there. The red line describes your volatility, the volatility on your account, and this is something we talked about in detail in the previous tutorial. So it kind of shows us how much you need to earn in percentage terms to get back to your original balance if you have a loss on your account. So it is quite good that the horizontal line is the risk in percentage terms. So for the Kelly chart, it makes sense, and it also makes sense for the red chart or the red line because what you're risking in terms of percentages, it might turn out to be a loss. So if you risk, for instance, 50% or let's say 40% of your balance, that's a point on that horizontal axis, and it kind of relates to a point on the red line, which tells you that if you lose those 40%, how much harder it will be for you to get back to your original balance. So let's not forget that the red line is compressed and stretched out, compressed vertically and stretched out horizontally. That's something that we need to keep in mind when doing our analysis. So the first step we're going to do is we're going to plot the half Kelly. We're going to talk more about the half Kelly point in the next tutorial. At this stage, we will just reference it, and it kind of breaks our chart up appropriately and will allow us to look at the different types of risk exposures. But we'll definitely talk more about why the half Kelly is an important point. We'll talk about that in the next tutorial. So the way I like to look at this chart and analyze it is by breaking it up into 4 sections. So we'll have the color legend here on the right, and the 4 sections will be yellow, orange, red, and black. To start off with, the yellow section is the one to the most left. It's between 0 and half Kelly, and it's called the conservative section. So if you risk anything between 0 and half Kelly, as you can see, your volatility is quite low. Your returns are also quite conservative, and therefore that's why it's called conservative. And also you're not risking that much. So it's kind of a safe area. So once you've calculated your Kelly, and then you can derive your half Kelly. And if you're risking anything below the half Kelly, you kind of, according to this method, can deem your trading to be on more of the conservative side. Next, the next section between half Kelly and Kelly is called the aggressive section. So if you're risking anything in that area, that means that you're getting better returns, but also your volatility is going up. So therefore, if you do incur a loss, it will take you longer to get back to the balance that you had before you incurred the loss. And let's not forget here that the red line is compressed, so in reality it is growing exponentially. So in the orange section, the volatility is much higher than in the yellow section. Next, and this is where the interesting part comes in, you've got the over-aggressive section. This segment of the chart, the red segment, is called the over-aggressive segment because even though you still are making profit in the long run, what's happening is your volatility is increased drastically compared to the orange and yellow sections. But more importantly, there is no need to be that aggressive in your risk taking, because for any outcome in the red segment, there is a matching outcome in the yellow or orange segment. So as you can see, the return, the green line here goes up towards the Kelly and then drops off. So that means that wherever you pick a point between Kelly and 2 Kelly, there will be a matching point between 0 and Kelly that will give you exactly the same return with lower risk. And therefore, there is just no point in being that aggressive. So in our coin toss example, why would you ever risk 40% of your balance if you can get exactly the same return in the long run by risking 10% of your balance? Now, you might ask at this point, Kirill, that doesn't really make sense. What if I have one specific trade and it's a good opportunity, and if I enter with 10%, I'll only earn, say, $1,000. If I enter with 40%, I'll obviously earn 4 times more. I'll earn $4,000. So this whole thing about being over-aggressive doesn't make sense to me. Well, that example is a single trade. Yes, of course, in a single trade, the more you risk, the proportionately more your return will be. But what we're talking about here is a long series of trades, some of which are profitable, some of which are losses, but like it's long-term trading we're talking about, where you've conducted a lot of transactions, or you're planning on conducting a lot of transactions, and what your outcome will be in the long run. And that is why it applies to trading so well, because ideally you should have a trading strategy, something that governs the way you enter and exit the market. And therefore, it's not just a one-off thing for you. You're going to apply this strategy over a series of months or maybe even years, and you want to know what your outcome will be in the long run rather than what your outcome will be on this specific trade. If, on the other hand, you don't have a trading strategy and you're just looking at one individual trade and you're just making your trades ad hoc, then my advice to you at this stage is to go and get a trading strategy, because that is the most important underlying part. You have to have some sort of rules that govern your trading. You can't just enter the market whenever you want to. So that's why over-aggressive is called over-aggressive, because there's no need to be that aggressive. In the long run, it won't benefit you. You can always find a better risk exposure, a much lower risk exposure with the same return. And finally, we've got the insane risk-taking segment, and that is anything above 2 Kelly. As we remember, at 2 Kelly, we always break even. Well, if you ever go over 2 Kelly, so for instance, in our coin toss example, over 50% of your balance, you are inevitably headed for ruining your account. So even though in the short term you might have a few profitable trades that will bring you a lot of money, in the long term, after everything averages out, your balance is going to start depleting rapidly, and the further you are into the insane area, the quicker you will lose all your money. And this is a very important part. A lot of traders overlook this area. They think that, yes, I'm taking more risk and I'm getting more profits, but it all comes down to what happens in the long run, because you're here to trade, you want to make a living out of it, or you want to be profitable in the long term. And you don't, if you don't take into account this insane type of risk trading, then you're falling in that category of traders that might end up risking too much without even knowing that you're risking too much, and heading for ruining your balance. And be careful here, because it might sound like insane risk trading is like 70% or 80% of your balance. Sometimes Kelly can give a very low percentage. So if your Kelly is only, for instance, 5% and your 2 Kelly is 10%, then even if you're risking 15% of your balance on every trade, you are already in the insane area. And that also illustrates how important it is to consider money management in your trading, and to understand where exactly your Kelly lies before you decide how much you want to risk on every transaction. I hope this was useful. In the next tutorial, we will talk more about the half Kelly and why it's so important and valuable. We will use the insights that we derived today, and I look forward to seeing you next time. Until then, happy trading.